Yo, what's up, guys? It's Ray, and today is Tuesday, August 8th. It's 7:30 a.m. Pacific. So, market's been open for about an hour. The day after the panic sell on Monday, we'll check up on the markets in a bit. I did want to spend a little bit of time to go through what VIX is, since it's literally what's happening today or recently. So VIX is a volatility index. It's quite important when it comes to how options are priced. So let's just go through this list real quick. What is the VIX? The CBOE, or Chicago Board Options Exchange Volatility Index, or the VIX, is a measure of the expected volatility. Expected volatility. The VIX is based on the options prices of the S&P 500 index, and is calculated by combining weighted prices of the index's puts and call options for the next 30 days. So the VIX is calculating the options of the S&P 500, which is the main index these days, combines the weighted prices of puts and calls for the next 30 days. So essentially just 1 month of time out expiration, right? So like quite short term. The VIX is designed to reflect investors' view of the future US stock market volatility. So how how do investors view the volatility of the US stock market in the future? That's what it is. Is it going to be more volatile or less volatile? We'll talk about kind of the numbers in a bit. Often referred to as a market fear gauge, the VIX is used by investors to measure market risk, fear, and stress before they make investment decisions. You've got a golfer. What does the VIX measure? The VIX is forward looking. All right, we get that. It's looking at the future. And it seeks to predict. Investors are seeking to predict the variability of future market movements. So they're trying to use VIX as a measure of like, hey, how much is it going to be more volatile or less? This is the opposite of actual volatility, which measures the variability of the prices that we already know. So there's going to be like a measure, a forward-looking VIX is forward-looking, and then there's actual volatility, like what actually happened. The fact that the VIX represents forward-looking or historical volatility is important, as it is based on how much investors are willing to pay for the right to buy or sell a stock. The premium of an option can be used to represent the perceived risk, the perceived level of risk in the market. The greater the perceived market risk, the more investors are willing to pay for insurance in the form of options. And we can talk about this point in a little bit. So think of options premium and VIX as if there's a higher chance of market risk, then investors are willing to pay for a larger insurance from a put premium, like buying a put to protect a position. When investors anticipate large upswings or downswings, they often look to reduce risk by using options to hedge their positions. Hedging is a form of insurance which involves an investor taking an opposite position in a stock through buying an option. So they'll have, shares of Apple, but then they'll buy puts on Apple. So as insurance that if Apple fell, then the options will make money against the position. So an overall increase in option prices will indicate a heightened market uncertainty and higher expected volatility. What can investors learn from the VIX? When there is a spike in the VIX, this means traders in the S&P 500 options market expect that market volatility will increase. The higher the VIX index, the higher the fear, which according to market contrarians is considered a buy signal. So yesterday's VIX was 65, and I don't think we've seen that since COVID 2020. So that for some people is considered a buying opportunity. Of course, the reverse is true. The lower the VIX, the lower the fear, which indicates a more complacent market. Like this is right here is super important. All right, guys, I don't want to skip over it. When the VIX is high, like yesterday at 65, it can be sometimes considered a market signal, a buy signal. When the VIX is low, like how it's been the last few months, it means it's a complacent market. And when the market gets complacent, then you're going to have volatility. In general, VIX values is greater than of 30 is considered a heightened sense of, so, anything greater than 30 means they're scared. Anything lower than 20 is more stable. In 2008, the VIX index was at 60. So it was like, yesterday was almost like the '09 thing. I mean, Bitcoin was down 20% at one point, right? And which was a good buying opportunity when the asset was down 20%, like you just pick it up. And I think NASDAQ futures were down 5% at one point. So, huge fear. Anyways, I'm gonna keep it a little bit short this one, or maybe a little bit. So when there is a spike in the VIX, that means traders in the S&P 500 options market expect that market volatility will increase. I mean, that's where we got it from. The higher the VIX index, the higher the fear, buy signal. You guys can, do more research on the VIX. I'll show you quickly on like the VIX here. So it was actually 55. I thought it was 60 something, but the VIX opened up at 55, which is considered super scary, right? Above 30. And then today it's down more. So it's like it was a buying opportunity. Sometimes you can think of it like that. Oh, 65, right the hell. So we were below 15. If we just drew a line at 15 over here, we were below 15 most of 2023 and 2024, right? So except this one spike over here to 21 back in April, this is considered a complacent market when it's low, below 15. And then when it got complacent, we dumped. And then it might be a buying opportunity. Who knows? This is the latest development. Cool. All right, 2 more minutes. Or we'll talk a little bit more, I guess. So markets can go in trends. This is called like a trend, or it can go in a range where there's no trend. And so this is a trend and this is a range. All right. And when there's trend, it pretty much says there's more buyers and sellers and a supply and demand, right? There's more demand than supply. And when there's a downtrend, then there's more supply than demand. And there's more people looking to get out. When the sideways range, then it's called indecision. It's like, hey, when it gets to here, there's supply, right? And then when it gets to down here, there's demand. And it keeps doing that pretty much like the small caps. If you look at small cap charts, it was a lot of indecision. And then finally there was a breakout, a euphoric breakout on the charts, and then a return to reality, right? So on the breakout and return to reality situation, because if you think about it, in July, small caps at least rallied like crazy. I mean, we could pull it up. We rallied from like the 15th all the way to here, consolidated for half indecision, right? And once August came, actually, it was like 3 days of selling and huge selling, right? Even yesterday was like epic selling. And that just goes to the VIX complacency of investors. One could view that as the complacency of the investors. So what does this have to do with kind of my trading system and trading strategy and what I was trying to show you with the Canva? There's going to be trends like this downtrend and this uptrend, and there's going to be periods of sideways consolidation, kind of like this right here. And that's just what markets do, right? When we look at the weekly view, you're going to see there's been an uptrend, downtrend, uptrend, and then a whole shit ton, almost an entire year of just a range, right? We just draw a line here and a line there. I was trying to explain that to you guys here, right? So we're going to look at charts in a little bit. And the reason I wanted to bring that up is because you could do a trend trade, which is my typical system that I teach, because you just stay with the trend and you stack your edges in your favor. There's another way, which is called range trading, which you just you sell supply and you buy demand. This is not what I do, just so you guys know. And then there's a mean reversion trade, and what the mean reversion trade means is that, well, the mean means average, so returning to the average. And what that means is if it's super stretched, so to speak, like this is a moving average, it'll return to the average. So this is a mean reversion type trade. So if you're a speculator, you can say, hey, look, we pulled back way too far. Market's gotten way too complacent. And we're going to trade it to the reversion to the mean. Same for yesterday, right? It was another mean reversion trade. Why am I explaining this? Because in the future, when I develop the GPT, it's gonna understand my trend capability and look out for those. And it'll also be aware of the fact that there are mean reversion setups, which means if it's overstretched to one supply or demand, then you want to play a mean reversion tactic, which would have paid off if we look at the charts. So what are we looking at here? We are looking at yesterday's scans. We're looking at yesterday's scans, and I'm just gonna, yesterday was a sea of red, right? And then today is mostly green. So let's look at the charts. I don't know what this stock does. Pharmaceutical, using my indicator here, we can see a bunch of just indecision, right? Even with the orange candles in terms of crossing over. Huge sell-off and a huge gap up today after earnings. And like, this is just clearly is not a trending market right now. So if I had a GPT, I'd be like, we're not in a trending market. So why am I trying to show this right now? Because you're going to, it's going to show a sell signal, and you're going to be using a swing trading momentum trend strategy in the wrong time when the market is in a choppy, volatile, non-trending, right? So when it's a trend, you use the trend strategy like on the left. And when it's a non-trend, well, then you play the mean reversion strategy, which is as close to the range strategy as you're going to get. Meta was the one that got away. I fucked up on Meta because I bought on this day, or I bought on this day. I sold on this day, which was okay. But there was a rebuy here, man. This white candle is actually a rebuy. So it'd be interesting to have GPT understand this rebuy signal right here. And it would have paid off 4% today. I don't know. All right, here's another one where the signal didn't work. Hey, Ray, why did I go short and I'm getting squeezed? Are we on a trending market, or are we in a consolidating indecision market, or are we in a high volatility market like now where yesterday was down, today was up, tomorrow could be down, the next, where are we at? Where are we at with things? Now, based on what we learned at first in terms of volatility spiking, it could be a potential buy to dip opportunity. So maybe today, you enter longs here, a lot of long, or I don't know, because tomorrow can go down again. You just have to understand what kind of environment we're in. Now, if you can construct a thing such that it knows service now looks decent. Service now looks decent. So I think the main thing I wanted to showcase is like you got to understand like this right here is just a bad stock for us. You know, you're not going to make money with the strategy using, you know, picking the DVA. We've got to look for uptrends and downtrends. So can't count low out. Lows is just, yeah. I mean, I think that's the main thing. It would have been great to have took the meta trade on the white signal, but it's all good. It's all good. This would have been a very profitable options trading. So we had a buy signal. I got complacent and got in early. But if I was just watching a little bit more patient and wait to the end of the day here, and we closed above the moving average, and then bam. Not a lot of reds. I'm not. What's Oxy? Oxy. I think the main thing is like, hey, in these periods of non-trending environments, high volatility, like we got to switch off the strategy. We can't be using a trending strategy and expect to make money in a non-trending market. That's the main lesson here. You know, we got to be buying something like right over here on Exxon, and then capture this run or capture these sell signals. But you know, right here is just indecision. If there's anything we learned today. All right, I'm gonna cut the video here. See you in the next one. Peace.